I suggested one last time.
Mm-hmm.
And can you remember what it was?
Yeah, it was crude oil.
Okay, crude oil. Yeah.
But I think then we switched to gas because like it reaction.
Oh, gasoline.
Yeah, because I think it was too correlated or something like that. Like
no, the problem with crude oil was when we looked at that.
Yeah.
You remember?
Yeah,
you remember what the problem was? Yeah, what was the problem?
That everyone wanted to sell their oil, but they were paying money to kind of like people to buy their oil because they didn't want to have it delivered in that regard, so they couldn't store it. So yeah, I think that was
oil prices went negative for a little while, and that's sort of a bit detrimental for any portfolio, and it doesn't really help us much with what we're trying to do here. I mean, we could use negative oil price and see what happens, but there's also this thing called RBOB gasoline, which is effectively a product of crude oil. And so in a sense, it's actually a bit better to use this for now. And the ticker symbol is RB equals F. So we could just use that. And then what we could do is, all right, so we've got RBOB, which has a relatively low Sharpe ratio. Now the question is, will this help us to get any better in what we do? And the cool thing that we can do is we've already got our returns calculated up there. So we could technically just apply the same formula here and just add another 0.5 and rerun it. And there you go. We've actually gotten even better. 0.7, not a lot, admittedly not a lot, but we got a slightly better Sharpe ratio. So, all right, so we've got 3 weights now and 3 assets. Now the question is, how do we plot the P&L curve of this?
I mean, that's a good question, because I think we would have to kind of take for each the profit and loss and then add it up. For example, it could be negative or something for one asset and positive for another. And then we would take the average, so to say, like, or the rest.
Yeah.
Our final, like win and profit and loss.
There's actually a fairly simple way to do this here. So what we can do is, first of all, we get the results from our minimization and we write them to something. We call it res, right? And so you remember that in this res, when we printed it out, the x was effectively our weights, yeah? Res.x, that's our weights, yeah? And so all we have to do now is we just go do this again. Instead of w, we just go res.x. Yeah? And then all we have to do is we plot the cumulative sum of R. And here we go. That's it. That's actually the result of all 3. And now what we can also do is we can plot our other instruments along with it. And we use alpha equals 0.5. Then it looks a little bit less imposing. And we actually can distinguish. So there you go. So you see, these are all our different instruments. And this is the resulting instrument, which obviously has a much higher Sharpe ratio than all of, I mean, our highest was 0.54, and then our Sharpe ratio is 0.7. That's significant. That's quite a bit better than all the others. So that's actually a pretty good result. And now you could just go ahead and do even more of those if you wanted to. There's a few funky things we could do as well. For example, we could plot a bar chart of our weights. So we could do something like plt.bar, and then we go list, and then we get reds.columns. So that's basically giving us the x coordinate, and then we go res.x here. So this gives us a bar chart of the different weights that we have in our portfolio. Now you can see that in fact when we have 3 weights, they don't add up to 1 anymore. So if we go res.x, see this doesn't add up to 1 anymore.
Mm-hmm.
Now,
but does it add up to 1.5? Because I think it does, right?
Yeah, but it should actually, what we actually want is to add up to 1.